This is Sacha Human from Cirrus Research. I want to call your attention to our latest risk metrics report. It's a quarterly report that centers on various risk appetite measures, crowding measures, credit, et cetera, trying to put together these key markets and how they're interrelated. In the latest report, risk aversion heats up globally. Investors are acting on their fears. Now, we've talked a lot about this in the last few months as the US data, the risk measures for the US have begun to really collapse. This started about 6 months ago, but it's meaningfully hit some levels now where it is significant. And the bottom line with risk measures is that risk appetites, they tend to be contra in nature. In other words, when we're love risk, in other words, you're at the upper boundary of this data, it portends fairly tough things 6-12 months later. When risk appetites are truly bottoming, it tends to point to higher absolute returns, valuation start to matter, quality matters. These things seem to reverse course. The problem is most key markets right now, when you look at some of the sampling data, some of the most dramatic breaks, the US, that's in the purple line, the blue line is Canada, and the light blue line is Europe. These are examples of markets that have collapsed sharply in the last 3-6 months. And so while we think this is something that's valuable, that's constructive, in other words, if investors are not just talking that they're scared, because there's tons of headline risks out there, but the fact that they are acting on their fears suggests that there will be value in the markets. And at some point, we definitely want to look opportunistically. The problem is that all of these markets are converging right now. And to some degree, over the next weeks and months, we probably want to play much more defensively as we watch the dust settle. If you look at this bubble chart, the x-axis represents risk aversion. Left-hand side is on the risk aversion side, to the right would be euphoric. The bottom line is a lot of these key markets are left of center. In other words, you've got the US in the most extreme measures of risk aversion. You've got Japan, you've got Canada, you got Europe, and even Latin America. So what we're saying is that if globally investors are starting to pull back from risk taking, we may want to watch this play out before we begin to really leap in here. One other observation that's important is that we've been observing in Asia, emerging markets, the high yield markets there had really sold down, and spreads were remarkably high. This thin blue line here basically says that you had emerging market high yield spreads at over 1,400 basis points. That's pretty much pandemic-like levels, or in fact, for Asia, this was higher than the pandemic peaks. So what's really going on here is there's tons of fears. Clearly, some of this is related to China, real estate, et cetera. In the recent few weeks, however, we've seen this spread start to adjust back downwards by a couple of hundred basis points. So we think this is important, something to watch, and potentially to begin to look more opportunistically in Asia. So when we look at valuations, Asia Pacific is one of the most discounted markets. It's potentially a little too complicated right now to really meaningfully look at China. But we do think with spreads starting to narrow, valuations in the right place, we should begin to look more opportunistically in that region. For any questions, feel free to call us at Cirrus or send an email. The report has just been sent out. Thank you very much.